Assalamualaikum to Dr. Azriza. Today we're going to present our group presentation. This is our group members. So let's start.
Ahmad worked as an intellectual property lawyer with a net salary of 10,250, while Sarah worked as lecturer at University Malaya with net salary of 12,000. Next is Ahmad and Sarah wishes for their children. First is for their daughter. They wish her to be in University of Science Malaysia, taking in Bachelor in Biomedical Science with honours for 4 years, which include total fees for their education is 16,000. Next is for their son. They wish him to be in University of Technology Malaysia, taking Bachelor in Civil Engineering with honour for 4 years, which takes 50,000 total fees. Ahmad and Sarah have a total household income of 22,250 and monthly commitment to spend is 6,500, where they put 10,000 as a seed money that they want to invest for their children. We, as their financial advisor, we advise them to invest in unit trust called Manulife Investment Management Berhad. The success owned by Manulife Investment Management Berhad as a unit trust can guarantee a return and cash flow for the investment that will be made by Ahmad and Sarah.
Ahmad is 37 years old while Sarah is 35 years old. Young investors like them usually have a higher risk tolerance because they have so many time to be free from potential losses in short-term market. In addition, young investors like Ahmad and Sarah often have a higher risk capacity. This is because they have more time to be free of losses when they retire decades away. Second is investment horizon. Ahmad and Sarah's investment period are within 16 to 18 years if they invest starting now to finance their children's university education fees in the future. This long time frame allows them to take on high risk investments such as equities that have a potential to earn higher returns. This is because they have time to be free from market fluctuation and can get a higher return investment. Third is financial obligation. In this case, Ahmad and Sarah likely have ongoing financial commitments such as house loan, car loan, utilities, medical costs, auto insurance, credit cards, and so on. This commitment can affect their risk capacity because they need to ensure that they can meet the commitment without compromising their family's well-being.
Next, I will explain about asset allocation strategies. To accumulate a sufficient amount for the university education fee for the children, the investment plan should balance growth potential and risk management. Ahmad and Sarah can allocate the asset as stated. Firstly, for the early stage, 0 to 10 years, which is long-term investment that focus on capital growth. 70% of equity, they should invest in equity fund that give high return for the investment. 20% of fixed income in low-risk bond fund, this allocation ensuring some of the stability for them. Another 10% allocate to alternative investment such as balance fund that give moderate return. Secondly, for middle stage, 11 to 16 years, which is medium term of investment that focus on gradually reduce the risk and maintaining some growth of the investment. 50% allocated in equities to reduce exposure by changing into dividend that focus on lower risk fund. 40% of fixed income allocated to increase amount in bond fund for greater stability and predictable return. 10% of money market fund that has high liquidity to improve portfolio liquidity. Lastly, for final stage, which is 17 to 20 years, is short-term investment that focus on capital preservation. 60% of fixed income allocated to emphasize stability through bond fund, 20% of equity to maintain small equity exposure for minimal growth, and allocated another 20% of money market fund to increase liquidity to ensure fund are ready for other unexpected educational fees or expenses. This investment strategy according to their long-term education saving goal by prioritizing growth in the early year investment and then shifting to safe and liquid investment. They can secure their children's education by following the asset allocation plan and regularly reviewing their investment.
Telling about the short details about this selection of unit trust. They have a long-term growth potential for 16 until 20 years old for this child education approximately. The high return of this using for the Manulife investment is 7.5%. So this is very good for the long-term investment. And the historical performance of this Manulife, they offered consistent distribution which is 8.2% from 2023 and 2024 for the current. And Manulife have a larger funds, so this typical more stable will manage the market fluctuations. For the ratio, they have a lower ratio. And the risk rating profile Manulife also provide them about the risk level by using the calculation measure like standard deviation, Sharpe ratio, Jensen alpha, and the Trino. And this also have created the short list of the fund for providing to the clients and the checking liquid, dividends, payout, and currency risk. They also have a monitor funds over the regular review about the performance.
Performance analysis. We have 12 months of performance analysis, which is for 2023 till 2024. Fund return is equal to 37.38%, benchmark return 16.95%, outperformance positive 20.43%. The key drivers is overweight in property sector, strong stock selection in industrial and technology sectors, and offset by underperformance such as construction and foreign stocks. Next, we have 5-year performance, which is 2019 till 2024. Consistent outperformance, fund has outperformed benchmark over the long term. Volatility, short-term fluctuation to 2020 till 2021, but steady upward trend overall. For the volatility and risk-adjusted return, higher volatility is more volatile than benchmark, especially from Jan 2024 onwards. Risk-adjusted, strong returns despite higher risk due to sector allocation such as property, industrial, and technology. For investment proposition, high returns driven by active sector allocation and stock selection. Higher risk, suitable for higher risk tolerance investors, medium to long term, strong performer in favorable market conditions.
Next is risk assessment. The first risk is political risk. Manulife Investment Management Berhad say there will be two important events that need attention, namely the presidential election for the United States of America and Malaysia's corporate result reporting seasons. Manulife Investment Management Berhad hopes that the corporate result reporting season in Malaysia can show better earning prospect. Next is inflation risk. The government tried to balance fiscal discipline and drive the country growth. This is driven by the strategic investment and improving economic fundamental. This lead to the local equity market is positive and comprehensive from responsible fiscal consolidations and much needed revenue booster and taxes that are not expected on dividend that guarantee shareholder wealth. The third one is interest rate risk. When the interest rate rise, then the value of fixed income will usually decline and may be lower the market value of the funds. Any changes in the prevailing level of interest rate will not impact the earlier deposit rates that have been agreed between the manager and the financial institution. And the last one is currency exchange risk. The exchange risk is driven by the occurrence of inflations which affect the interest rate in the market value. Net foreign fund debt in July 2024 is encouraging and has made the year-to-date flow is a net positive. Manulife believe the market can continue to expand and provide opportunities for the potential increase of the ringgit against the USD. Manulife realized the importance of balanced and quality company portfolio to become a unit trust that can help investor get a better return. Next part is risk management. The first method is hedging. Manulife use the hedging method when the business partner involved is a financial institutions that have minimal long-term credit and show a strong condition for goods and timely payment of financial obligation. Manulife say closely monitored all another step will be made to unwind the position if there is a significant adverse change to the issuer. Next method is asset allocation. This is to track the value of microeconomic variables and their impact on asset allocations. When the financial market is in bad states, assets can be allocated into defensive instruments and investors need to be informed first. This will help reduce the adverse impact on the fund's value. And the last method is strategic investment decisions. This is to push us boundaries and strive to build competitive fixed income solutions and leverage global expertise and capabilities. Through this method, investment can be made anywhere in the world, holding a portfolio of high-yielding and emerging market income assets and leveraging their global network of credit analysis to manage risks. By this method, expanding the investment market can include multiple sectors and currencies to increase potential returns while
This
reducing.
investment projection, we have made it for Sarah and Ahmad. The group projection, the expected return for 7.5% for both children. They have to be carried by the average annual return 7.5%, initial investment for 5,000 for both of them, and monthly contribution also same 500 for both of them. If you can see the initial period, there's a difference of the daughter and newborn. Daughter is 18 years old and newborn is 18 years old. For the future value from the seed money of 5,000, the daughter can gain 5,900 for, and for the newborn, they can get the 18,379, and for the money contribution they also can get for daughter is 184,616, and for the newborn son they can get 454,608. For the total fine, we can be total by the seed money and the money contribution. So for the daughter, we can see that the total is 200,520, and for the newborn is 472,287. They have the first cost inflation, which is the daughter can gain 998 and 400 for their cost, and for the son they can gain until 836,000 for their cost. So we can see that the inflation might decrease more than the actual price of the cost. For the investment cost, we have to minus for the total fund with the estimate cost inflation, which is they can get a deficit for both because they have a more inflation. So the total of daughter is 797,880, and for the son is 463,013. So we can see that they have a deficit, but this can be managed by a strategy that can adjustment, increase the contribution. Like for the investment, consider a higher yield investment and also review to cover all this problem, and can be managed all the time.
For tax consideration, Sarah can claim EPF and life insurance premium is covered until 7,000 ringgit, charitable donation to orphanage, full exemption subject to HLD and approval, breastfeeding equipment, maximum relief until 1,000 ringgit once every 2 years, childcare fees for children under 6, maximum relief is RM 3,000, and SOCSO per peso, maximum relief is 350 ringgit. For Ahmad, he can claim EPF and life insurance premium up until 7,000 ringgit, insurance premium for education and medical purpose 3,000 ringgit, charitable donation to orphanage, full exemption to with proper receipt. 4. So per peso, maximum relief is 350 ringgit, and 5 is zakat and fitrah payment full debit for the total zakat or fitrah.
Now let's see fees and expenses. First, management fees is a fee paid to an investment professional entrusted to manage the investment for Ahmad and Sarah. Management fees typically range up to 1.5% per annum of the NAV of fund. High management fees will reduce investment returns more quickly, especially in the long term. If Ahmad and Sarah's invest 10,000, means that 1.5% of the fund value will be deducted every year to cover the management fees. Second, the sales charge serves as a commission for the unit trust agent. It was charged at the beginning of Ahmad and Sarah's investment. Sales charge are common among equity and balance funds. If Ahmad and Sarah invest 10,000 and sales charge is 6.5%, this means that 6.5% will be deducted from the first invest to cover the sales charge. Third, redemption fees are less of an issue for long-term investors like Ahmad and Sarah, as long as they don't redeem their investment money early. If they need to redeem their investment, there is a 2% redemption fee. This will reduce the amount of money that they will receive in the future.
Reviewing the investment is important to Ahmad and Sarah achieve their education fund goal. A monitoring schedule and performance evaluation will help them to stay on track and quickly know about any shortfall, then they can make new plan. I will talk about the importance of regular monitoring and reviewing of the investment. First important is to track progress toward goal. This can ensure the portfolio align with the target amount needed for the education and it allow them to make corrective measures if something bad happen. Second, they can adjust the investment based on the market condition and quickly adapt when the market change and shifting to a better plan when they keep monitoring their investment. Third, they can adjust the investment based on life changes. When they face changes in income, expenses or new goals that can affect their ability to contribute into the education fund, regular review can flexibility help them to relocate the fund based on the changes. Fourthly, they can change the plan when there is better offer and replacing underperforming fund and optimizing the allocation in certain fund to increase the portfolio performance. Lastly, they can reduce risk as the goal approach. It allows a gradual shift to safer and more liquid investment that protects the accumulated amount from market downturn as the withdrawal date nears. In conclusion, a disciplined monitoring and reviewing framework by following the structured schedule is important to manage risks and challenges for long-term education saving plan. And this can make sure their investment moving in line with the objective, adapt into changes, navigate uncertainties, maximize return, and finally secure their children's future education.